$6 trillion vanished in under 60 minutes. Gone, evaporated. If you bought silver at 121 or gold at 5,600, you're hurting right now, staring at a wall of red. But listen carefully. This wasn't bad luck. This wasn't a glitch. This was a robbery in broad daylight. Right now, most people are panicking. They see prices collapsing and assume the bull market is over, that the run is finished. They're wrong. What you just witnessed wasn't a death spiral. It was a trap. A deliberately engineered bear trap set by the largest players on Earth, and most retail investors walked straight into it. If you don't understand why gold dropped $500 in 1 hour, you're going to get slaughtered. You'll panic sell at the exact bottom, seconds before the market rips higher. But if you do understand what just happened, this isn't a disaster. It's the buying opportunity of a lifetime. I'm going to show you why this crash happened, explain the hidden mechanism that actually controls the global economy, and give you a specific time window that tells us when the bleeding stops and the rocket ignites. But first, we need to examine the crime scene. January 29th, 2026. 1 minute, everything looks perfect. Gold at all-time highs, silver screaming higher. Charts look unstoppable. Everyone feels invincible. Then someone flips a switch. In less time than it takes to watch one sitcom episode, fortunes are erased. Gold collapses from 5,600 to 5,100. Silver dumps from 121 to 108. Think about that. If you had $100,000 in silver, 11,000 vanished while you were making coffee. That money didn't disappear. It transferred. It moved from your pocket to someone else's. Here's how. It's called a liquidation cascade. Sounds complex. It's not. Picture dominoes. Price drops a little, leveraged traders get margin calls. Broker says add cash or we sell. They don't have the cash, so positions get dumped. That selling pushes price lower, triggering the next margin call, then the next, faster and faster. Selling creates more selling, a waterfall of red candles. While you were refreshing your screen wondering what broke, nothing broke. The system worked exactly as designed. It was hunting. Hunting overconfidence. Hunting stop losses. The media will call this volatility. Noise. They're lying. Crashes this fast, this precise, this violent are never accidents. Institutions knew this was coming. Banks, hedge funds, algorithmic desks saw the signals days ago. While you were buying the breakout, they were loading the trap. Sell high to retail, crash the price, buy it back from panic sellers for pennies. That's the game. And here's the good news. I've seen this movie before. I know how it ends. Late December 2025, same pattern, same panic, same screaming headlines. Everyone said the market was dead. Then January exploded. Gold ran 30%. Silver ripped 65%. Biggest rally in decades. History doesn't repeat, but it rhymes. This crash may be the fuel for the next launch. So why did it happen? Why today? Why this hour? Not a mine shutdown. Not hatred for gold. The metal didn't change. The price tag did. And it changed because of one invisible force 90% of investors ignore. The DXY. If you don't know what the DXY is, you're trading blind. The dollar index is a scoreboard for the US dollar against other currencies. And here's the rule you need burned into your brain. The dollar and gold sit on a seesaw. When the dollar goes up, gold goes down. When the dollar falls, gold rises. They are enemies. They cannot win at the same time. Gold didn't really crash. The dollar spiked. The floor shot upward, making everything else look like it fell. To understand gold, stop staring at gold. Watch the dollar. This is the engine under the hood. Gold and silver are locked in a cage match with the dollar, and they always move in opposite directions. Not sometimes, always. Gold is priced in dollars. When the dollar gets stronger, it takes fewer dollars to buy gold, so the price falls. When the dollar weakens, you need more dollars and gold explodes higher. Playground seesaw. Dollar slams down, metals fly. Dollar jumps off, metals rocket. Here's the mistake costing retail investors thousands. You obsess over gold charts, silver charts, drawing lines and triangles. Professionals don't. Wall Street watches the dollar. The DXY is the crystal ball. It tells you what gold will do before gold moves. Today wasn't a mystery. The DXY surged. Dollar flexed against the euro, yen, and pound. The seesaw slammed down. Metals got crushed. Not manipulation, not conspiracy. Mechanics. But because you were watching the wrong chart, you were last to know. Hedge funds saw the dollar spike and sold immediately. 5 minutes later, you saw the red candle and panicked. You became exit liquidity. If you want to stop losing money, stop watching metals and start watching currency. Dollar up, hide. Dollar down, buy aggressively. Now the real question. Why did the dollar spike today? 3 levers were pulled, 3 triggers. And the third one is a nightmare for silver holders. Trigger 1, the Federal Reserve. The Fed controls the printer, and right now it's hawkish. That means high rates, tight money. They're terrified of inflation returning. High US rates attract global capital. Investors dump euros and yen to chase higher yields in dollars. Demand spikes. Dollar surges. DXY explodes. Gold gets crushed. Everyone expected rate cuts. The Fed said no. Rates stay higher longer. Dollar becomes king. Gold becomes collateral damage. That's trigger 1. Trigger 2 is China, and silver holders need to listen. China's economic data is ugly. Factories slowing, manufacturing shrinking. Silver isn't just money, it's industrial fuel. Over half of all silver goes into solar panels, electronics, electric vehicles. China is the factory of the world. When China builds, silver rallies. When China slows, demand collapses. Bad data hit today. Factories stalled. Traders panicked. If China sneezes, silver catches pneumonia. That's why silver dropped harder than gold. Silver is money plus machinery. When the machine breaks, silver breaks harder. This metal runs the modern world. Phones, EVs, data centers, AI. Silver is the bloodstream of technology, and China is the heart pumping it. When that heart slows, silver bleeds. That was trigger number 2. But I told you there were 3 reasons, and this third one is what gave everyone permission to sprint for the exits. Reason number 3 is unfolding right now in Washington, D.C. The U.S. government is staring straight at a shutdown. January 31st, 2 days from now. If Congress doesn't sign the check, the lights go out. We've seen shutdowns before. Usually it's political theater. They argue, markets wobble, then a deal gets signed at the last second. But markets hate uncertainty. They hate not knowing. When investors can't see what's coming, they stop taking risk. They rush to cash. They sell first and think later. And context matters. We just came off a massive rally. Gold was up 30%. Silver was up 65%. People were sitting on piles of profit, just waiting for an excuse to lock it in. The shutdown wasn't the cause. It was the trigger, the spark, the snowflake that started the avalanche. So stack it together. The Fed staying hawkish. China's factories slowing. Political chaos in Washington. One of those is bad. All 3 hitting at the same time is a perfect storm. That's how you vaporize $6 trillion in an hour. Now, if you want to survive this market, you need to understand the relationship between gold and silver, because most people get this dangerously wrong. They think gold and silver are twins, moving together at the same speed. They aren't. Gold is a cruise ship. Silver is a speedboat with a Ferrari engine. Same direction, totally different velocity. Silver is gold on steroids. When gold moves 5%, silver moves 10 or 12. When gold runs 10%, silver can rip 20. That's incredible on the way up. It makes people rich fast. But gravity works both ways. When gold drops 8%, silver can get crushed 15 or 20. Look at today. Gold fell 9%, already a huge move. Silver dropped almost 11. That's not random. That's the silver multiplier. This is the price of trading silver. It offers the biggest gains, but it will punish you twice as fast if you're careless. And here's the detail almost everyone missed today. The clue that proves this was about the dollar. Look at last Monday. Silver collapsed 14%. It got annihilated. But gold barely moved, down only 2%. Why? Because that move was about factories, industrial demand, silver-specific news. Gold didn't care. But today? Today, both of them fell together. Hard. When gold and silver die at the same time, the killer isn't industrial news. It's macro. It's the dollar. The DXY spiked and choked both metals instantly. If you want to predict crashes, stop staring at metals. Watch the currency. When the DXY spikes, brace for pain. Now here's where things get interesting. I'm looking at these charts, and I've seen this exact movie before. Not years ago, weeks ago. Late December 2025, the final 2 days of the year. A violent crash out of nowhere. Panic selling. Liquidations cascading like dominoes. Sentiment was horrific. Social media screaming the bull market was dead. And then January started, and the market exploded. Now check the calendar. January 29th, 2 days from month end. We just had another sharp crash. Panic selling. Liquidations flooding the system. Same timing, same fear. Same pattern. The question everyone is asking is simple. Does February repeat January? Are we about to see another massive pump that leaves skeptics behind? I think we might, and here's why. First, understand what didn't change today. This is critical. The crash was about the dollar, about the Fed, about weak hands getting shaken out, but the fundamentals didn't move an inch. While you were panicking, Tether was still buying 1 to 2 tons of gold, like they do every single week. They don't care about 60-minute candles. While you were staring at red, BRICS nations, China, Russia, India, were still stacking bars. They didn't sell, they bought. They treat crashes like Black Friday. De-dollarization didn't reverse in an hour. The silver shortage didn't magically disappear. 5 years of supply deficits weren't fixed today. Mines are still dry. So what actually changed? One thing. Sentiment, fear, emotions. Weak hands sold. Strong hands bought. Sentiment flips fast. It flipped negative today. It can flip positive tomorrow. And this is how real bull markets work. A sharp crash isn't the end. It's the reset. It flushes out leverage. It scares tourists. It creates pain so big money can step in quietly and accumulate. They buy fear while retail panics. Then the trend resumes. Stronger than before. Faster than before. We've seen this movie again and again. So the only question that matters is this. Are we still in a bull market? Forget feelings. Forget fear. Look at the numbers. Gold is still massively up on the year. Even after today's punch to the face, silver is still up huge. Central banks are buying more than ever. The dollar's long-term trend is still down. Today wasn't a trend change. It was a blip. Nothing says the party is over. Everything says this was halftime. But I know what you're thinking. Here we go again. Another guy on YouTube telling me to hold the bag. Another voice saying buy the dip while my account is bleeding. I get it. You're tired. You're scared. You just watched your net worth drop double digits in the time it took to eat lunch. The last thing you want is someone telling you to stay calm. I'm not telling you what to do. I'm showing you the data. I'm showing you the pattern. I'm holding up a mirror to history. What you do with it is your decision. I just don't want you making that decision blindfolded. So let's look forward. There are 3 paths from here. Scenario 1, the bull continues. This crash mirrors December, a fake out, a bear trap. February opens strong, new highs by March. Silver clears 150. Gold punches through 6,000. I give this a 60% probability. Scenario 2, more pain. The Fed stays aggressive. The dollar keeps flexing. China slows further. Gold tests 4,800. Silver tests 90. 30% probability. Scenario 3, chop. sideways. No highs, no lows. Just boring, brutal, soul-crushing price action that bleeds traders dry until nobody is watching. Then the real move happens. 10% probability. But I promised a real prediction, not hedging. I'm putting my name on this. I believe silver is back above 120 by February 15th. Not March, not someday. February 15th, 17 days from now. Here's why. This crash knocked silver from 121 to 108. A $13 discount in 1 hour. Do you honestly think industrial buyers, solar manufacturers, tech giants are ignoring a sale like that? They've been waiting for a dip. They just got it. Zoom out. $13 feels catastrophic in the moment. Compared to the rally we just had, it's a scratch on the paint of a rocket. December says we bounce. Fundamentals say we bounce. Panic overselling says we bounce. And remember the date, February 15th. By then, shutdown drama is gone. Fear fades. Buyers step back in. 120. Write it down. Screenshot this. Hold me accountable. Which scenario do you think plays out? Moon or meltdown? Drop it in the comments. I read everyone. But understanding what happened is useless if you don't know what to do next. Knowledge is power. Action is money. So here's the playbook. If you hold physical gold and silver, coins in a safe, bars in a vault, do nothing. Absolutely nothing. Physical metal is not a meme stock. It's not crypto you flip on your phone. It's insurance. It's a life raft. You don't cancel insurance because of a bad day. You don't have a loss until you sell. Until you hand that metal to someone else, the drop is just pixels on a screen. It didn't change how many ounces you own. Ignore the noise. Turn off the news. Come back in 6 months. The reason you bought didn't change. Only the price tag did. Group 2, leverage traders. Today was your wake-up call. Leverage in a market like this isn't risky. It's fatal. Liquidations trigger liquidations. That's how accounts go to zero. Stops don't save you when price gaps. You get wiped at prices you never planned for. It happens every crash, every time. If you're using leverage on metals right now, cut it, reduce it, kill it. No gain is worth annihilation. Group 3, cash on the sidelines. This might be your moment. The best buying doesn't happen during celebrations. It happens when fear is thick, when red candles stack like Tetris, when people are panicking. That's when money moves from the fearful to the patient. But only buy what you can hold. I can't promise the bottom is in. Buy in layers. Small now, more if it drops. Average in. And only with money you don't need next week. Last group, if you bought the top. Silver at 121, gold at 5,600. That hurts. Watching 11% vanish in an hour punches you in the gut. I know that feeling. But you're at a fork in the road. 2 choices. Panic sell at the bottom and make the loss permanent. Hand your money to the guy buying from you right now. Or hold. Grit your teeth. Accept bad timing without confusing it for a bad investment. A good house doesn't become worthless because you bought it on a rainy day. History rewards patience, but only if you can survive the emotional ride. Only you know if you can. Let me give you some perspective so you can actually sleep tonight. In March 2020, the world fell apart. Gold crashed 30%. People panicked. They sold everything. They said gold was finished. And then what happened? By August, gold was at an all-time high. In 2008, silver collapsed by 50%, half its value gone. Everyone said it was over. They wrote its obituary. And then, silver went on one of the biggest runs in history. 3 years later, it hit $50. Every bull market has corrections. Every single one. It's like climbing a mountain. You stop to breathe. Sometimes you slip, but you keep climbing. The question isn't whether you'll slip. You will. The question is whether you have the guts to hold the rope. And that courage doesn't come from bravery. It comes from understanding. If you understand why gold and silver matter long-term, you can survive the short-term pain. If you don't, every drop will shake you out. You'll buy when it feels safe and sell when it feels scary. That's how people stay poor. That's why I make these videos. I'm not here to tell you what to buy. I'm here to give you the map so you don't get lost in the woods. So here's what I'm watching right now. 4 specific signals. Signal 1, the DXY, the dollar. If it keeps rising, brace for more pain. If it rolls over and falls, metals bounce hard. Signal 2, February 1st, the day after the shutdown deadline. What happens in the first 48 hours of February tells us everything. That's the starting gun. Signal 3, China. Watch the headlines. If they stimulate or print money, that's rocket fuel for silver. If factory data keeps getting worse, that's bearish. Signal 4, the Fed. Listen carefully. Hawkish talk strengthens the dollar. Dovish talk weakens it and sends metals higher. Those 4 signals are your compass. Now understand this. There are 3 types of people watching right now. The panicker, refreshing their account every 5 minutes, sweating, thinking about selling just to stop the pain. Fear is driving the car. The statue, frozen, doing nothing, staring at the screen and hoping it magically fixes itself. And the student, taking notes, understanding what happened, preparing for the next move, knowing that crashes are sales for people who are ready. Which one are you? Be honest. Here's the brutal truth. Markets are a machine designed to move money from the impatient to the patient, from the emotional to the prepared. Today, $6 trillion changed hands. It didn't disappear. It moved. Some people lost it, others gained it. Which side were you on? If you panic sold, you handed your money to someone who was waiting for you to break. If you're still holding, you still have a chip and a chair. The game isn't over. And if you're sitting in cash, watching quietly, pay attention. These moments are rare. December crashed. January pumped. January crashed. February is next. The pattern is obvious. Will it repeat? Drop your thoughts in the comments. I'll be back February 1st to see who was right. If this video helped you calm down or understand the chaos, hit like. It helps this reach other people who are panicking right now. If you're not subscribed, fix that. I don't sell hype. I don't sell hopium. I show you reality. Share this with the friend who bought the top. It might save them from a permanent mistake. Remember, 6 trillion gone in 60 minutes. If you bought the top, thoughts and prayers don't pay the rent. Understanding does. Patience does. The crash already happened. You can't change it. What you can control is your response. Panic and dig deeper. Freeze or learn. The market doesn't care about your feelings. It only rewards people with a plan. If you didn't have one this morning, make one tonight. What do you do if we drop another 10%? What's your move if we rally 20? Write it down, because there will be another crash and another rally. Always has been. Always will be. Volatility isn't a bug. It's the engine. You can't stop the waves. You can only learn to surf. I've watched geniuses lose everything in an afternoon. I've seen average people retire rich. The difference wasn't IQ or degrees. Smart people blow up accounts every day. The difference was ice in their veins and a plan they didn't abandon when it felt like the world was ending. Today was a test. The market held up a mirror